Hello everyone, welcome to week one lecture videos. Our today's topic is financial institutions specialness and risks. We will be covering two chapters today, chapter 1 and chapter 7. So first chapter 1, why are financial institutions special? We have a couple of learning objectives in this chapter. So first of all, we will be discussing why financial institutions are special, how financial institutions are different from other business organizations. We will discuss that how financial institutions' specialness lead to greater regulatory oversight, and we will also discuss the few other sources of specialness of financial institutions. I will be discussing several videos on these learning objectives. So first of all, I will be talking about why financial institutions are special. To understand financial institutions' specialness, let's imagine a world in which financial institutions do not exist. In such a world, the world where financial institutions do not exist, households generating excess savings by consuming less than they earn would have only two choices. They could either hold cash or they invest in the securities issued by corporation directly. In such an economy without financial institutions, the level of funds flowing between household savers and the corporate sectors, however, will likely to be low. And there are several reasons for that. First of all, once they have lent money to a firm by buying its securities, households need to monitor or check the actions of that firm to ensure that the firm's management neither absconds with nor wastes the funds on unprofitable projects. Such monitoring actions are extremely costly for any given households because the collection of sufficiently high quality information require considerable time and expense relative to the size of the average household saver's investments. Given this, it is likely that each household would prefer to leave the monitoring to others, and in the end, little or no monitoring would be done. The resulting lack of monitoring would reduce the attractiveness of and increase the risk of investment directly into corporate debt and equity. So that's about monitoring costs. Secondly, the relatively long-term nature of corporate equity and debt, the lack of a secondary market in which households can sell these securities creates a disincentive for households investors to hold the direct financial claims issued by corporations, especially given the choice between holding cash and holding long-term securities. Households may well choose to hold cash for liquidity reasons, especially if they plan to use their savings for consumption expenditures in the near future. And finally, even if financial markets existed to provide liquidity services by allowing households to trade corporate debt and equity securities among themselves, investors also face a price risk on the sale of securities. And the secondary market trading of securities involves various transaction costs. Because of monitoring costs, liquidity costs, and price risk, the average household saver may view direct investment to corporate securities as an unattractive proposition and prefer either not to save or to save in the form of cash. However, the economy has developed an alternative and indirect way to channel household savings to the corporate sector. This is to channel savings via financial institutions. Because of cost of monitoring, liquidity, and price risks that I mentioned in the last slide, as well as for other reasons, savers often prefer to hold the financial claims issued by financial institutions, for example, deposits and insurance policies. And financial institutions use this fund to invest in the corporate securities, which is shown in this graph. These graphs essentially indicate how financial institutions play the role of intermediary between households and corporations and perform the functions of broker and asset transformer. So that's the end of our discussion on specialness of financial institutions. In the next video, I will be talking about these two major functions of financial institutions. Thank you very much.